and promoted the idea that capitalism has always been the way to lift up people from poverty and to create a widespread wealth for millions. Through several channels, for example, such as competition. Today's book actually is challenging that idea. Is that true or is that not true? This book, to start with, has been endorsed by many prominent figures in the field, ranging from Nobel laureates such as Michael Spence, New York University, Angus Deaton from Princeton, and other top universities and Ivy Leagues. It always has been endorsed by a prominent figure and policy makers, Minister of Finance of Greece, the Prime Minister of Australia, the former one, plus many, many others people have been endorsed. However, the most important endorsement that captured my attention was not actually an endorsement, Denise, and I guess you know what I'm talking about. It was one of those hedge fund billionaires that he says, I cannot endorse that book. It is too harsh on the business people and the companies. So pretty much that grabs an attention. Okay, well, we would love to read what's going on in this book. So moving from the book to the author. Our author, she's a senior fellow at the American Economics Liberties Project, the co-lead of the American Access to Market Initiatives, and she is a thought partner of SheEO. I mean, we heard about CEO and CIO, but SheEO, and it seems that is more into supporting the female rights. She's also a board chair of the Pre-Distribution Initiative, which is a multi-stakeholder project to improve investment structures and practices to address systematic risk like inequality and climate change. Our author writings has been featured in publications like Financial Times, Washington Post, and others. She's also been invited as a speaker to many prominent places like Hong Kong Foreign Correspondent Club, one of the biggest in the world, to the town hall of her hometown, Seattle, and many others. She also holds a master's degree from Oxford University. So in behalf of John D. Gerhart Center for Philanthropy, Civic Engagement, and Responsible Business, please join me to welcome Ms. Denise Hearn, the author of the book, The Myth of Capitalism. Please, Denise.
Thank you so much, Dr. Ahmed, for that wonderful introduction. And I feel really thankful to be here. And I'm really excited to get into the discussion portion with everyone and to hear some of your thoughts and reflections on how some of these issues may present in Egypt or in the Middle East. I always learn so much from these conversations. So thank you very much for having me. I am going to share my screen. I have a presentation I'll give for about 25 minutes, and then we'll move into the discussion portion. So let me make sure that you can see this. Ooh. Okay, perfect. So I wanted to start by asking, and maybe people can put in the chat, if anyone knows who this is. Are people familiar with who this woman is? And I unfortunately can't see your faces. So, well, I want to hazard a guess that perhaps at least one or two people are familiar with her. This is Lena Khan. She is the newly appointed 32-year-old chair of the Federal Trade Commission in the United States. And she's become somewhat of an international phenomenon. She's quite famous. And she really symbolizes a new movement that has taken place, particularly in the US, but it has been growing around the world for the last number of years. And she is a strong advocate for anti-monopoly, bringing back anti-monopoly practices in our regulatory agencies and reviving sort of the original zeitgeist of antitrust law, which was challenging corporate power. And the reason I wanted to start with her is because she symbolizes what can happen when a relatively small group of think tanks, academics, social movement leaders, and others, and the public get together and express frustration with the current system and desire to see change. And it's been quite amazing under the new administration to see a number of appointments which people thought were quite potentially far-fetched, fringe even in terms of the original, or in the sort of popular zeitgeist movement around antitrust. And now to see these people appointed to the key positions within the government to make change. And so I wanted to go back and sort of say, okay, well, how did we get to this point where we're at, the crux of hopefully the dawn of sort of a new era in how we approach some of these questions? Well, back in 2017, I was working for a macroeconomic research firm based in London, and we would sell our research to hedge funds and family offices and institutional investors that wanted to have updates on where we thought the various components of the markets were going. And this was one of the things that the charts that we used to use with our clients. It was a leading indicator for wages, and investors care about wages because they tend to invert corporate profits. And if you know where wages are going, then you might have a sense of whether corporate profits are going to increase or decrease as a result of that. And you can see that starting in around 2015, the indicator really starts sort of diverging from historical trend, and all of a sudden it stops working. We kept saying, oh, wages are supposed to rise. Wages, according to our indicator, should be rising, and they didn't. And our clients were getting frustrated with us because we were wrong. And so we started asking some deeper questions. Why is this dislocation happening? And for me as well, I had always been interested in inequality and the kind of the structural drivers of inequality. And so the person who founded the investment research firm, Jonathan Tepper, who is also my co-author on the book, him and I started doing a lot of research. We read hundreds of academic papers, news articles, and what we found really surprised us. And we weren't expecting to find this as one of the key problems that we think is a key explanation for why markets were starting to, wages and other portions of markets were starting to become sort of unhinged in different ways. And at the time as well, Piketty's book had come out, and many people were starting to ask, is capitalism itself broken? We can see that inequality is rising, workers are having more difficulty, there are structural flaws in markets. And so we set out to ask this question. And what we found in the US in particular, but this is true all over the world, is things like this, that 2 companies control 70% of the beer that Americans drink. 5 banks control about half of the nation's banking assets. And in 75% of the country, if you're an internet user, you have one internet provider that you have access to. So 75% of Americans are dealing with a local monopoly when they try to access high-speed internet. And this became apparent across so many different industries: cheerleading, funeral services, cattle farming, meat packing, insurance. The list is endless. Kidney dialysis, pharmaceuticals. And it became quite apparent that even when we have the illusion of choice, there's many different brands as consumers we think that we are choosing from. They're often owned by one conglomerate, one large brand. In this case, this is Elesoro Luxottica, and they own all of the different brands that you see there on the right side, 62 different brands. And so as a consumer, you go to the store and you think, you think you have all of this choice, but that's not the case. And so what we found was a high degree of industry concentration, as I mentioned, across nearly every imaginable industry. And this, this is deeply problematic for a number of reasons. And as we began to research, we found this to be the case. So here is a chart to describe or sort of visualize how concentration happens. This is banking, the banking industry in the United States. And you can see that starting in around 1990, there were multiple different banks that consumers could choose from. And over the years, as they merged and consolidated, we ended up with 4 major banks. And again, you could replicate these charts across nearly all industries. This is really interesting. This is from The Economist. It's a little bit dated now, but they did an analysis on the number of times that the words competition and competitors showed up in company annual reports. And you can see that starting in the 2000s, it basically completely drops off, and companies don't even talk about competition anymore in their annual reports because, you know, they barely have any. I found that interesting. And you can see here that one of the reasons that this happens is because the regulatory agencies that oversee mergers in the United States, which are the FTC and the DOJ, they used to bring actual antitrust cases. They used to, you know, more heavily scrutinize mergers. And interestingly, in this chart here, you can see that when that happens, as in the 1940s through the 1960s, where they were bringing a lot of antitrust cases, you actually saw that that M&A volume, you know, decreased significantly. And then going into the 2000s there, you can see that the antitrust cases completely drop off. And we have these mega merger waves. And, you know, and we're experiencing one again during this pandemic, that there is a large number of mergers and acquisitions taking place. And interestingly, some of the other things that happen are, you know, workers' wages. As we started the presentation with, you can see here that corporate profits, as they have risen over time, the amount of corporate profits that go to employee compensation has also declined, and so you have this widening gap. Partially, the reason for that is it's very difficult to bargain against a monopolist. As an employee, your bargaining power is greatly reduced. And also we've seen the decline, you know, over many years of things like unionization. And so as unions have fallen away, then there are few mechanisms for employees to be able to advocate for wages or other kinds of benefits. And then we also see that the top 5 companies now are capturing more value. This was a chart, a more recent chart from 2020, where the top 5 largest tech companies, Microsoft, Apple, Amazon, Alphabet, and Facebook, now account for over 20% of S&P value. So in no other time in history, and you can see it relative to the dot-com bubble in 2000, have we had so much concentration of value in just a few single companies. Also, what's interesting is the amount of corporate profits that are going to buybacks. So you can see here in this chart how stock buybacks have dramatically increased in recent years. I just read a stat recently that was fascinating, which is that Apple, over the last 6 years, despite the fact that its operating income has barely changed, the stock price has quadrupled in value. But in part, that was because they did $337 billion of stock buybacks. And buybacks are a way where, you know, you buy back the stock from the public, and so there's fewer stocks available, and so it immediately increases the price of the available stock. So it's a form of financial engineering and manipulation. It used to be considered illegal, or it used to be illegal because it was considered stock manipulation. But during the 1980s, under a deregulatory agenda of President Reagan, the buybacks became legal, and then, you know, there was over time a steady increase in their use, and today there's evidence that 2021 is going to be a record year for stock buybacks as well. And so there are, you know, so during the pandemic as well, unfortunately, this is getting much worse. There are a number of private equity firms who, you know, as Main Street businesses have really struggled. We've seen the largest companies be able to get federal, you know, bailouts, or private equity companies are consolidating industries. When they see distressed companies, they purchase them because they're sitting on record amounts of cash themselves. We also know that the tech firms have done more mergers during the pandemic than they did during the dot-com bubble as well, despite the fact that they're under increasing antitrust scrutiny. So unfortunately, things are in some ways getting much worse, and the pandemic increased this kind of consolidation. And one interesting trend as well from this is when you not only get increased concentration of power, of corporate power, but you also get increased concentration of wealth, because of course investors benefit tremendously from this kind of concentrated economy, because monopolies can use their market position to begin to extract rents. So they can either they can squeeze labor, pay them less wages, and boost their profits that way. They can squeeze their suppliers and cause them to, have to scramble. And then they can also charge consumers higher prices. So we've seen a huge rise in markups, which is the amount of money that a company will charge above its production cost of a certain good or service. And markups have also dramatically increased in recent years, mostly in concentrated industries. And so when you get this kind of market positioning of the largest companies, then they're able to massively increase their profits, often not by actually innovating. That's one of the challenges, is that it greatly reduces innovation, because they will either acquire companies who have interesting IP or patents and sort of bring them into their company. They may fail to commercialize those innovations because they're not core to their business model, or maybe they see it as a competitive threat, and so it's sort of a catch and kill tactic. But innovation massively slows down, and they do actually less spending on R&D overall as well. And so as that's all happening, then you're getting this concentration of wealth with particularly with shareholders and those who do own company stock. In the US, less or around 50% of Americans don't own any stock whatsoever. So this has massively, of course, increased inequality. And now I'm getting to this slide, one of the interesting one of the other knock-on effects of that is that we've seen that the velocity of money has slowed. So velocity is the quickness with which money circulates throughout the economy. And so you can see that since, around the last 20 years, we've seen a decline in how money is circulating. And, money is sort of like it's like the bloodstream of our economy. If it's not circulating, if it's not getting to all of the different places that it has the capacity to sort of enliven, then you're ending up with a body that is slow moving and is on the brink of collapse potentially. And so you can see that here, this velocity of money issue, I think is also very interesting, and I think has a tie into consolidation. And so, again, how and why did we get here? The three key reasons would be the deregulation in the 1980s, particularly under President Reagan, where they relaxed merger guidelines. They thought that it was a philosophical viewpoint that governments were ineffective, and if you removed them as a barrier, then markets could be allowed to exist and function smoothly, and that free markets, are the best sort of ways of organizing society. And I think what we failed to realize was that markets are public institutions that need rules to guide them. And when you take away public institutions and democratic institutions that set rules, you leave a vacuum open. And what's happened instead is that we've now have de facto private regulators, the largest companies, setting market rules, and it's often in their favor. And so we're now in a position where the largest companies, through lobbying, through regulatory capture, are able to shape markets to their benefit. Secondly, the second reason is complicit regulators who really did fail to bring antitrust cases, merger review, and who sort of felt captured to a certain type of intellectual view that antitrust should only focus on the consumer, benefit to the consumer. It's called the Consumer Welfare Standard. And so all of the legal cases that were brought tended to be viewed through this lens. And they failed to integrate this understanding of how concentrated power doesn't just affect consumers, it affects all of these different stakeholders that I mentioned, workers, suppliers, democracy at large. And so through the narrow lens of consumer welfare, particularly in the technology industry, their focus was on, as long as companies could prove that through merging, they became increasingly efficient and they would pass those savings on to consumers, then they were allowed to merge. And what we've seen with technology is when you're offering free products, that worldview is insufficient to deal with the kind of complex problems that we have now as a result of the technology industry, because they were offering free products. And so of course it was great for consumers, or so went the thinking. So the second reason was really this failure of regulators to properly bring cases and review mergers and to see this as a problem. And it's not a partisan issue. Both Democrats in the US and Republicans equally failed in this regard over the last 40 years. But thankfully that tide is turning, as I mentioned. And then thirdly, the other key reason for this is the pressure from shareholders to maximize profit, and the sort of key financial incentives that sit underneath the economic system that we have. And I'll talk a little bit more about that later. So, in conclusion, I sort of failed to mention this at the beginning. The reason we called the book The Myth of Capitalism was because people believe that capitalism is free markets. And what we wanted to prove was, regardless of what you think about capitalism, whether you like it or you don't, we can't credibly say that we have free markets. They're not broken. They just don't exist. They're sort of a figment of imagination if you look at the current state of markets. And industry consolidation is really the picture of capitalism today, and not just in the US, but around the world, which increases inequality, it lowers wages, it slows productivity, and it increases prices and slows the velocity of money. And all of this creates a sort of systemic fragility of markets. So the solutions to this are, we need to, as I mentioned, revive the original zeitgeist of antitrust law to actually challenging corporate power, de-emphasizing the consumer welfare standard. We need to increase antitrust enforcement and merger review and pursue breakups of companies that have illegally merged, which is happening, like Facebook and Instagram and WhatsApp. We need to challenge anti-competitive and unfair contracts. So I speak to entrepreneurs often who are facing difficulty competing because of the dominance of a player within their industry. And often we see coercive contracts being used where, if they're a supplier, they are forced to do exclusive deals, or things like tying, as an example, is another way where you're forced to purchase multiple products instead of just the one that you want. So there's many sort of tactics that dominant gatekeepers will use. And unfair contracts are one of those. And then we, of course, need sector-specific regulation that will allow sectors to become, more broadly competitive and just fair, to actually have access to fair markets. So that sort of concludes the first portion. And I realize now that I should speed this up a little bit, but after the book came out, what I realized was that although we had advocated a number of regulatory reforms to deal with this problem, I felt like the problem went much deeper than we had scoped to deal with in the book. And I wanted to understand the kind of paradigms that underpin the entire financial ecosystem, the economic system. And I like this quote by Peter Drucker that says, if you want something new, you have to stop doing something old. And so I started investigating a lot of questions around, okay, well, how do we even understand economic value? What is economic value? Why do people operate with the financial incentives that they do? What are the kind of the incentives that sit underneath the systems that we have? And in every business school, around the country or around the world, they usually start with Porter's 5 forces, right? Which is that you want to be competitive, you want to build moats around your company, and you want to eliminate the threat of substitutes, the threat of new entrants. And I began really questioning a lot of the foundational premises that we operate with. Because what's interesting is there's something called the fallacy of composition, which is what's good for you isn't necessarily good for the whole. And one of the examples is a bank run. So if you think that the bank is going to become insolvent, you run to the bank and you try to get your money out as fast as possible. And it makes perfectly logical sense for you to do that as an individual. But when everybody acts in their own self-interest, it actually perpetuates the thing that you don't want to happen, which is the bank becomes insolvent and fails and bankrupt. And so when everyone actually acts in their own self-interest, in this case and in many other cases, it actually makes the outcomes worse overall. And the funny thing about this is that we have an entire economic theory and system based on this idea that if everyone maximizes their own self-interest, that it will make things better off for everyone. And so I began questioning that premise and many others that we find in traditional sort of neoclassical economics, and started a new project. Sorry, I haven't given this exact presentation before, so I'm out of order here. But I think there are kind of 3 responses you can have when you look at the current system that we have, and you either are like a believer, you think that things should essentially stay the same, you want to reform certain aspects of what we have currently, or you're a prophet in the sense that you think that there are many different alternatives that we should explore. And so very quickly, I'll just go through these. So believers, they operate on faith in the invisible hand. They tend to cite poverty and health statistics around the benefits of capitalism. It's lifted, all these people out of poverty. They want to, again, curtail government interference. They think that that's, the main problem to functional markets is that there's too much interference. And so they also tend to be slightly more libertarian in their views. And they believe that you can reach some sort of system equilibrium, that there is a balance point, that supply and demand have a natural meeting point in the middle. And if you just remove the obstacles, the market will self-correct and will self-balance. So those I describe as the believers in capitalism and in free markets. And then there are reformers who think that, tweaks are necessary. Maybe they advocate specific regulatory fixes. They tend to rely on sort of a moral reawakening of leaders. And so this tends to be things like the stakeholder capitalism movement, conscious capitalism, ESG, sustainable investing. So they think the current system is okay. We just need, a few tweaks either philosophically, or we need to make some adjustments in terms of how we regulate these markets to make sure that they are fairer. And I would say that the majority of time and energy and money goes to projects that sit in this category. And then finally, we have the prophets who, question some of the most basic foundational assumptions, things like private property. Is that something that we should revisit and question? They tend to be sort of second and order thinkers. So they're thinking about the first principles and questioning some of the foundational first principles, and then how they have systems effects all the way through. So they call for new paradigms, and they usually rely on a moral imperative logic versus a kind of instrumentalist logic around the business case. So oftentimes you'll see people making the business case for something like, well, if we invest in, carbon reduction, eventually that's actually the most profitable investment that you could make. And so a lot of ESG investing makes this claim as well. And I would say that profits tend to avoid using that kind of logic. And they say, actually, we want to question win-win dynamics. We want to, understand what actual economic value is, what it means in the first place, and why we have a system that orients economic value around things that are ultimately destructive to humanity and the planet. And so A couple of new economy prophets that I personally like, Robin Wall Kimmerer, who's an indigenous leader in the US, has a fantastic book called Braiding Sweetgrass. Kate Raworth, who I know that you've had on here to speak as well, who is absolutely phenomenal. Ha-Joon Chang, who's an economist, I think also fantastic. And there's many, many others who are really asking us to revisit some of the foundational paradigms. I know I'm going over, but maybe I can just really quickly go into this and then we can do more in the discussion portion. But I started a new project to investigate this myself, and I called it Embodied Economics. And the reason I called it Embodied Economics is because I believe that the current economic systems that we have, as well as some of the key economic theory, tends to be very disembodied, and it also, again, it kind of exists in this plane of thinking as everyone as a bounded, autonomous individual with their own self-interest, and they're sort of in this cocoon that is disconnected from other relationships, from other and also from nature. And so a couple of friends and I put this together, and we came up with what we called the Forgotten Five of economics. And those are the body, care, nature, interconnectedness, and power. And I'm just going to talk through these quickly, and then if we want to go into more detail later, we can. But, the body, the reason we center this again around the body is that the economy is nothing more. It's a human invention, the economy. And the body is, or the economy is nothing more than billions of bodies and brains contributing to a shared human project. And an economy that would actually orient around the shared needs of the body would be radically different than the one that we have today. Also, economics makes no, traditional economic theory makes no provision for the fact that the body that you're born into, the country you're born into, the gender, the race and ethnicity, that all of these things, because we live in an imperfect system that isn't neutral, the market is not neutral, that all of those things have a profound effect on your ability to participate in markets on equal footing. And so modern economics really makes very little account for power, aside from anti-monopoly and corporate power, but it doesn't really deal with individual asymmetries of power and how they show up in markets. So that's one reason we want to center the body. Also, bodies get old, they get sick, they're born, and they ultimately die. And we have an entire system that ignores care and the caring economy. So what would it look like to revalue care in different ways? Nature, we have long seen ourselves as divorced from nature rather than embedded. In fact, we are nature. And so what would it look like to reorient our foundational thinking around embeddedness in nature? Interconnectedness is my placeholder for complexity thinking and systems. So a lot of economic logic is very mechanistic. So if you print money, it's going to cause inflation. A equals B. And in complex systems, these kind of linear relationships rarely exist. And because complex systems they display emergent properties where they're nonlinear and non-mechanistic. And so, and yet, the entire way that we govern economic policy tends to be very mechanistic. And we think that we can raise a lever here or turn off this over here and reach a certain outcome. And, central banks have failed at this for almost their entire, existence in many ways. And yet we still think that, it's a bit of hubris to think that we can operate this way. And then, as I mentioned, power. And so those are what we're deeming the Forgotten Five. And what we're advocating for is that they actually become the foundational five of how the prism through which we think about and try to come up with new ways of organizing economic value. And so a couple of examples that I find are really interesting, like, what if a tree or a forest could print its own currency? How would economic flows adjust for that? What if we added the care economy, which economists in the US have tallied at over $4.5 billion per year. What if we added that to GDP tomorrow? And then all of a sudden, GDP in the US has a huge spike, and therefore we could take some of that economic value that's been created and gift it back to citizens in the form of cash payment somehow. What if we fundamentally revisited this idea that we own land, and instead we had sort of a treaty with the land where we recognized that it was something that we were stewarding and not owning. And so we didn't have a fundamental legal right to actually be destructive to the land. Things like this, I think, are really interesting. And there are many different proposals out there to sort of fundamentally reorient our financial and economic systems around different goals, because we were able to do that. And I'm just gonna, sorry, I know I'm going over. So I'm just gonna end with one quote that I think is fantastic from my favorite systems thinker, Donella Meadows. And she says, "The future can't be predicted, but it can be envisioned and brought lovingly into being. Systems can't be controlled, but they can be designed and redesigned. We can't surge forward with certainty into a world of no surprises, but we can expect surprises and learn from them and even profit from them. We can't impose our will upon a system. We can listen to what the system tells us and discover how its properties and our values can work together to bring forth something much better than we could ever have produced on our will alone. We can't control systems or figure them out, but we can dance with them." And so I hope that you will dance with me as we continue to ask these questions together and think through what is possible for a world that, and an economic system that fundamentally will serve our values and our human and ecological flourishing. Thank you so much.
Thank you very much, Denise. Actually, a very, very interesting presentation to the book and beyond actually the book. The point is, I don't have a question, and I see a couple of audience wants to ask a question, but let me, for a quick comment on what you said, especially the banks mergers and the deregulation. And also you put a graph for the velocity of money. Again, as you know, there has been an act that has been passed in 1999, known as Graham-Bliley Act, that allows the merger of the banks. And this is actually repealing what happened in the 30s after the Great Depression, is called Glass-Steagall Act, that did not allow mergers. However, during President Reagan's, as you mentioned, and they started phases of deregulation, again, and it continues all over and over President Clinton, and it went to the top at the President W. Bush. And at the end of the President W. Bush, as we see, the financial crisis did not only hit the US, but it actually spilled over to the world. My question is, to cut the long story short, is you talk about the reforms and how we can reform. However, the one who's very aware of the American politics would pretty much know that there is no much difference between the Republicans and Democrats. Again, once the President Obama came, people were very hopeful that he would fix things. However, he actually continued down the same path that his predecessors did, and he continued hiring people from the financial markets to run the government, giving them a power over what they actually screwed up. So I don't want to say that I'm a little bit pessimistic or not optimistic about what we can do, but what do you think, and the lobbies also, the role of the lobbies, especially financial lobbies, do you think we can get through the government and the lobbies and get what you said about the reforms? I mean, you convinced us that this can work out, but can we make them true?
Thank you. Yeah, thank you, Dr. Ahmed. It's a great question. And honestly, I don't know. I think that's why I sort of straddle my work between reform, like being a reformer, and trying to think more like a prophet, because I think that I think that we have an opportunity now, at least in the United States, where there is this resurgence of a desire to do something, and they are appointing people who really want to take this on, and I think have strong integrity. But I think that ultimately, even as well as we do, if we're able to get all that we want to do accomplished with new antitrust, enforcement and better merger review and all of these things through the current agencies that we have, I still think that it will ultimately be insufficient to solve the underlying system incentive problems that sit at the base of this, which constantly cause positive feedback loops to keep going. And so that constantly aim towards monopolization. The entire financial system essentially, exists to cause this kind of monopolization all the way from the top, because asset owners and allocators who sit at the top of the chain need their returns, and it goes all the way down through. And so I think that unless we start asking, broader questions about what types of markets we want to build, what kind of companies we want to build, and how, more generally, how we're actually going to reform money itself and how economic value circulates, I don't think that we'll solve this problem easily through the existing regulatory agencies for the long term.
Thank you, Denise. Thank you very much. Again, we have several hands up, but before I take them, I would recommend the Charleston Ferguson documentary, Inside Job. Again, it adds up. Actually, it contributes to what you're saying here. So I'll start from the very first beginning, one by one. Please, Vinit Sharma, floor is yours. Ask your question, please.
Yes, it was a wonderful talk, Danish. In fact, it was quite enchanting and quite analytical. But my basic question was regarding the the stagflation issue that the world is grappling with. How much does it relate with the the challenge that we are facing at this point of time? Because the multilateral institutions are failing. For example, recently we heard about the the crisis with the IMF. Had falling in line with as far as the China was concerned. She basically doctoring the report of the according to the the business ranking report, and basically giving them higher ranking. So how much does that compromise with the the integrity of the system? Because that is a serious lapse, and that basically means that the developing world and the many nations are basically lose out because of that. And my second question is regarding the financialization a challenge that the world is facing at this point of time, because that means basically that the tax system, everything gets completely lost out because of the for example, the Pandora papers that recently came out, Panama papers that came out a few years ago, that means that the entire system is completely compromised, and because of this there is a vast inequality even after this pandemic which has got the world completely collapsed. We are seeing that the inflation is glorified. The inflation is basically rising at this point of time, and still the food prices are rising, and the the pharmaceutical prices, everything is rising by big numbers because of the the policies of the governments, because of the low interest rates, and the real economy is completely crushed at this point of time. But still inflation is these central banks and no one is able to do anything about the inflation. But still, instead, in fact, the inflation is glorified that okay, that it is going to bring GDP growth, etc. Well, the GDP is going to be beneficial for the big corporates, or for the billionaires, but inequality has risen after the pandemic. But basically the the inflation is basically going to crush the the common man. So how much is that the massive disconnect that we are seeing between the real economy and the financial sector, because of this rise of stock market, etc., is to be blamed for that, and the policy makers are still not able to come in terms with that, because of and also the tech sector is basically completely has dominated the entire economies of the so how much do you feel that how can such issues be be sorted out in this complex world? Thanks.
Thank you. Yeah, thank you, Vinette. I agree with everything you said there. Absolutely. And I don't know. I don't know the answers to these extremely complex problems. But I think approaching the world with curiosity has allowed me to really uncover a lot of the issues that you're discovering. And or that you're talking about. And I think the financialization piece that you mentioned is absolutely huge. You know, one of the interesting things is that corporate valuations now are completely divorced from growth, in the sense that you know, the best example is Bitcoin, or sorry, that Tesla made more money earlier this year selling Bitcoin and carbon credits than it did ever selling cars. And you see that the corporations are now able to essentially manipulate their value based on you know, complex accounting mechanisms, or as you mentioned, tax avoidance, or you know, Uber used 50 Dutch shell companies in the past. And it's this really interesting time where, you know, the way that we think about corporate valuation is really different than it has been in the past. I mean, the way that we even think about profit is quite different. Profit wasn't conceptualized in early economic systems. If you had wealth, if you were a landholder, you were a king or an emperor, all of your assets were in land and in, you know, sort of treasure, various things, gold. And so profit wasn't actually something that really was part of our conception. Then even up until the 1850s, in the US, many sort of more industrial companies, they were more concerned with just making sure that they balanced their ingoing and outgoing goods. And so as long as they had a surplus at the end of the year, they were happy with that. Then you get into the industrial era, and Carnegie is famously quoted as saying, as long as you reduce your input costs, profit will take care of itself. So he religiously focused on, you know, lowering workers' wages and lowering input costs to industrial manufacturing processes. And then it's not really until then you get the rise of multinationals, and that's when you get this sort of idea that corporate profit needs to be tracked for its own sake, so that companies have an understanding of all of their disparate parts of the organization, where they are worldwide. And then now today, where we have this mark-to-market accounting, where a company's value is what the stock market says it is in any given second, it actually is quite like divorced from even, you know, 40 or 50 years ago, when it was more tied to the production and the underlying value of the assets that a company had. So I think there's endless things to work on in this system, because so much of it, the more you dig into these questions, the more you realize that anything that we exist, any system that we have, is really just a collective agreement of something that we as humans have decided to say, money has value because we collectively agree that it has value. So it's a social contract of sorts. And, you know, the firm is also a social contract. It's given license by the state to operate. So that means that all of these are changeable. We have the ability to completely change how we want to distribute economic value and how we want it to circulate and what kind of economy we want. And that's what gives me hope. That's what makes me keep doing what I'm doing every day, despite these massive hurdles and all of the problems and challenges that you mentioned, is that if the world is based on ideas and paradigms, we can change those paradigms. And so I'm excited to hopefully do that with all of you.
Okay. Thanks, Denise. Still have more questions. People are raising their hands and some people are putting in the chat box. So I would ask people on the chat box to wait. So I would ask Dr. Ali Aouni, please.
Thank you, Denise, for a very mind-opening. I think when you get a audience and you think, I have a few comments and a question, perhaps. In 2002, there was a book was called The Rule of Three by Raj Seth and by Jadish Seth and Raj Sisodia, which exactly what you're saying. The premise of the book is that in any industry, eventually you will have 2 or 3 players, major players, and they control 90% of the market. Now, the interesting thing is that Raj Sisodia, went on and he started what is called conscious capitalism. And he started talking about the healing corporation, which I find interesting parallels between it and the embodied economics. So anyway, this is one comment. Now, we always talk about 10, 20 years back. Remember, Ted Roosevelt had something called the Square Deal. This was in 1902. And it's basically promising the American citizen a fair deal. I mean, you're going to get a decent living. This is what he was promising. By the way, Ted Roosevelt was a very adamant opposing the starting of foundations, because he thought this would be a leeway for big money to get tax exemptions. So and he was a Republican. I mean, after the Depression came FDR. I mean, another Roosevelt, but he's this Democrat. And he was talking about the New Deal. He was talking about how to fix whatever misery was caused by the new Depression. Now, all of those guys are talking about stronger role of government, which is when you talk about Reagan, Reagan was saying that the problem we have is government. Government is problem. We should eradicate government. Another thing in the same line, one of the greatest American economists is Kenneth Galbraith. And Kenneth Galbraith talked exactly about those lines, about how you should actually curtail the power. And he was not just talking about big corporations. He was talking also about big unions. He was talking about that all the big players in the ecosystem manipulate the ecosystem to their benefit. Now, the interesting thing, he was opposed by Milton Friedman, Paul Krugman, I mean, the typical classical economist. The interesting thing, I mean, and you go figure, I mean, his book, one of his famous books is called The Affluent Society. The original title of the book was actually Why the Poor Are Poor. Now, I mean, probably, I mean, he was trying to connect a more politically correct title, but he's spot on. I mean, when you talk about affluence and under the affluence in the process, we've managed to create inequality, tremendous inequality. Now, to conclude, just a sort of, it's really about role of government. There are lots of economists. I mean, one of the interesting ones is Mariana Marcuse. And she keeps, I mean, in her latest book, The Mission Economy, she keeps talking over and over about how the costs are always public and the benefits are always private. She's talking about the government bailing failing companies out, and this is out of taxpayers' money, and then after that, off the hook. And she was talking also about there are many innovations that are actually started by government subsidy or by government even outright payment. An example that I just found, I mean, DARPA was a major investor in Moderna vaccine, which Moderna made billions out of it. So you can see the flow. I mean, it's a very powerful, the costs are public, but the benefits are private. But anyway, I mean, those are the few comments that just came in my mind, and I just wanted to share it with you. Thank you.
Thank you.
Thank you, Dr. Ali.
Oh, sorry.
Yeah, please, Denise.
Yeah, no, thank you so much for that. And I couldn't agree more as well. And those were really thoughtful reflections. And I think what's interesting for me when we come to the government conversation is I completely agree that there are so many instances where public dollar and, you know, public dollars and public value then get privatized through all kinds of mechanisms. I mean, the oil and gas industry receives enormous, you know, public subsidies, as well as Amazon. You know, when it goes into a local municipality or a state, they often get a lot of subsidies for coming into, or tax breaks, or any other number of sort of perks that are publicly funded, and that is a major problem, because to your point, then the economic gains from those activities then end up becoming, you know, siloed and concentrated in the hands of, you know, a small number of private investors. I think, though, what I'm also interested in is questions around governance. And, you know, I think that one of the most incredible people that's done work on this is Riane Eisler, where she talks about systems of partnership and systems of domination. And governments can also be systems of domination just as much as, you know, private sector actors, or there can be systems of partnership. And I think, you know, she says we need to move beyond these domination systems. And I think that really rings true to me. And what she also says is that, you know, capitalism and socialism still are based on a paradigm of dominance. versus partnership. And so I think there are lots of, and I haven't done enough work on it, but I think there are lots of really interesting experiments happening with different types of sort of citizen ownership, citizen governance. There's a woman in Taiwan named Audrey Tang who's done fantastic work on social innovation, using technology for social innovation within the country, and getting citizens really engaged in making sort of more, localized decisions about what they want to have happen. And I think that we'll see, I would like to see a whole bunch of range of different types of experiments happening like this, where we don't just have the top-down, sort of federalized approach to governance that we do now, where we can have multiple levels of democracy happening, and that people can participate in all these different levels in a way that is, much smoother than kind of the current system that we have. Because, I think government itself is an imperfect, federal governments, federal agencies are imperfect vessels. And there's been a few comments in the chat too about international governance organizations. And absolutely, we see the same problems, right, where they tend to be used for domination purposes. And so I highly recommend everyone check out Ria and Eisler's work on that.
Thank you. So next is Angus Blair. Please go ahead.
Thank you very much. Denise, thank you so much for the presentation. Absolutely fascinating. I agree with my colleagues. My own background is investment banking in the City of London, and I'm now in Cairo. So I'm part of that sinful machine, perhaps to a degree, and having expressed it and worked in it for a very long time as a fund manager and investment analyst. But anyway, it's quite interesting, a whole variety of points, and it's got me thinking just in listening to, because I've brought up quite a number of the topics that you have in your book in my postgrad economics class. But there are a few issues. One is the larger historic narrative, which is that economics and finance is very much an American narrative, and it's been very dominating and very, very difficult to chip into, criticize, critique for a very great degree. And it's quite interesting. I've been trying to think, I have already been trying to think, but you have been catalyzing that over the last hour as to what else we could be doing to make change. Because I very much believe that we have to do this, not just with climate change, but ownership, inequity, and all the things I'm certain we agree on. But I had a fund manager come in to talk to my undergrad class in finance last week, and I asked the question about share buybacks. And for me, it's a lack of creativity. And I think it would be better for everyone if companies with cash paid dividends or paid the staff better. But the institutional investors, and perhaps you can answer this, are a part of the problem. They say they want, ESG and everything else, but they are part of the problem. And I've been very lucky in life. One has doors open as an investment banker. When you sit with the IMF, the World Bank, African Development Bank, EBRD, EIB, and I challenged a few of them over dinner about 2 months ago. And it's quite amazing that the silence that one has amongst people I view as friends, but they find it difficult, if well nigh impossible, to debate, never mind critique, the structures. So I think that if we come up with some ideas, we have to find insiders within the IFIs and the multilateral development agencies and the institutional fund management industry, as well as creating at the bottom a new narrative. Because it's difficult, because companies are monoliths. Denise and I find it difficult, having worked with them, met them for many years, been a number one institutional investor analyst, being on the other side and working with them and working on antitrust. There's so many levels here that it almost calls for a committee of people to try to say, okay, we need to work on multiple levels. How do we do it? Because there seems to be disparate voices. So the question is, how can we organize to make the changes we need for a sustainable capitalism? Thanks.
Thank you, Angus. So nice to meet you. And it's really nice to see your face as well. You have just volunteered yourself to work with another organization I'm involved with, if you're up for it, which is the Pre-Distribution Initiative, which focuses exactly on this point. The locus of the change for a lot of the sort of conscious capitalism movement has been the corporation itself, the firm, and really has ignored the financial system and set of incentives that engulf the firm, really. And so my friend Delilah Rothenberg started a project working with institutional asset owners and allocators to think about all of the ways that the financial system, the financial structures themselves actually do exacerbate a lot of these problems. And so I couldn't agree with you more. And I think, you know, there are many constraints around this, because if you're a pension fund, of course, you want to meet your liabilities. Low interest rate environment is making that difficult. And so we see them getting into riskier and riskier asset classes. They're investing in private equity, which is hugely extractive and causes a lot of social harm. And yet they feel constrained. And then when you say, okay, well, what if we, you know, the consolidation within the financial system, or with even asset management, is problematic, right? We've got the big three, Vanguard, BlackRock, and State Street now, you know, really managing passive investing and exerting huge influence over financial markets. And so the consolidation of capital flows itself is also one of the structural drivers of corporate concentration. And so we try to talk about that. And I think what's interesting is when you do talk to folks, there is, you know, that's why I came up with that sort of, it's a bit trite, but that sort of believers, reformers, prophets dichotomy, because I think, to your point, it is very difficult for people sitting within the existing system to really think creatively about alternatives, because the positive feedback loops are so strong. And if you're in that position, there's a lot of reputational, you know, potential damage or other things if you start to question some of the more foundational principles. But even when we say things like, okay, well, what if we tried to deconsolidate capital flows where you might allocate more to the middle of the risk return spectrum instead of doing a barbell approach with your investments, you know, looking at things like equity, you know, redemptions, or sort of like what's revenue-based financing, or other forms that might be, you know, less problematic than loading the entire system up with constant debt. It's very difficult institutionally for, I'm sure you're well aware and you could speak to this, but it's very difficult institutionally for players to do that for a variety of reasons. So I don't actually know. I mean, this is one of my big questions that I am wondering, like the current system is so fragile, and particularly when you take in account, you know, all of the sort of natural externalities that have gone unaccounted for so long, that I sort of am getting to that point where I'm like the weirdo in the corner that feels like we, you know, if we don't do something really, really fundamentally different, and not just even these accounting projects of sort of internalizing externalities, I don't know if those are going to go far enough to get us to a point of avoiding, you know, mass extinction as a species. So I don't know. I would be curious to know what you think have seen or have found interesting. I think you're still muted.
You're muted, Angus. You're muted.
Angus, we can't hear you.
Cannot hear you. Unmute.
Yeah, I had to get permission from the team to speak. Thank you. I think, first of all, it's quite easy to become depressed, especially when one considers climate change issues and the monolithic structure of these companies that would fight one tooth and nail. I think that the European Union offers some hope, because there's such a different thrust and dynamic within the European Union. And you see that with the new request for corporate governance proposals, and the UK, frankly, too. I think it would be easier to find allies for this change in London and Edinburgh, and the fund management industries and finance, and in Frankfurt and Berlin and Paris and Amsterdam at the moment, that could then perhaps carry some weight and encourage others to do more, especially if funds allied to these changes were able to raise significant sums of capital. Then the profit motive would encourage the monoliths in the US to make changes, perhaps. But we've got some hope in that, perhaps in the amount of money that was raised for ESG related funds over the last few years, although there's been a bit of a clawback because of the lack of metrics to measure ESG. But I agree with you, it'd be quite difficult. It's quite easy to fall into a trap of thinking, oh, it's too late, we can't really do anything. But we find allies to help, the kind of new international sort of family and friends to be able to make the change, just as your voice is being heard tonight amongst people who have never heard it before. And the fact that for me, the number one issue is climate change, because in a few years' time, we might not be able to create change or sufficient change to make the change we want. So I think what you're mentioning by having institutional initiatives is a very helpful start, but you need to drive that and not let it fall behind. We need someone very strong that really pushes it. And I think we need far more women in finance too, because they have a voice that needs to be heard. But anyway, thank you very much for asking me to comment.
Thank you.
Thank you.
Can I just?
Yes, please. Sure, Denise. I would like to ask the audience if they would like to continue for 10 more minutes, because we would love to stay on this discussion for maybe 10, 15 minutes. So please, guys, stay with us. Please, Denise, go ahead.
Thank you. Yeah, sorry. I'm just having too much fun. I realize we're already way over our hour. But I was just going to say that one of the more interesting proposals I've seen, and I learned about it through a really interesting book called The Ministry of the Future, if anyone's heard of that. But he mentions a proposal in there for a carbon coin that would be issued by multiple central banks. And this is an actual proposed, I think people are actively working on it right now. So it would be issued by the central banks, and it would sort of accompany like a 100-year long-term duration bond that would pay more than US Treasuries. And the coin would be awarded based on carbon sequestration to either governments or to corporations, or so carbon sequestration, or if they actually left their assets stranded. And so I find that really interesting as one of a whole suite of things that we would need to think about to sort of reorient. Because right now, I mean, like Bitcoin as an example, I just don't find it interesting. I don't find it interesting because one, it's actually built on the language of mining, which is fundamentally problematic. It's also built on this idea of scarcity. So there's only a certain amount of Bitcoin, you have to mine it. Of course, it's very environmentally damaging, but the whole premise is solve this really hard math problem and then you get rewarded. What if we had a different incentive, which was the things that we actually need, like sequester carbon, or figure out some other, or I don't know, care for your relative that's dying or something, and you could be awarded this kind of value. I think these are the types of things we need to start generating alternative ways of structuring the type of system that we need, because, I think it's plausible. I think it just is going to require a lot of sort of imagination around how we want to reorient the incentive structures that we've built into the current financial system. And I don't know that central banks, I have issues with central banks, as does everyone, but I don't know if they're the proper place for that kind of proposal. But I think that given the institutional power that they do have, if you could redirect it in a positive way, I think it could be very powerful.
Well, Denise, we're having a couple of questions over here. Actually, there are not questions. There are a couple of people who are very, again, pessimistic about the role of the NGOs. Mustafa is talking about the role of NGOs and international organizations in the current system. But again, he came and replied to himself that he believes that they are highly politicized and they are under the influence of the government. So for example, IMF and World Bank, we can see that their budget comes from the government, even the WHO. During Trump's, when the WHO manager president came and he wants to do things, Trump again threatened that he would cut funds to the WHO. So I believe this also would apply if you want to add to that. Also, Hani Shinawi, he likes very much your presentation. And again, he's talking about the shareholders. And the corporation is to create shareholders' value for its purpose must be redefined at a higher level, and that must include the employees. Later, he says that I believe that the current structure are highly fragile and will ultimately implode. And again, this is from Hani. So if you do have any comment on these two people.
Yeah, thank you. So to the first point about the IGOs and NGOs and international organizations, it's not my area of expertise, but I will say that one of the books I read recently that I found absolutely fascinating was David Graeber's Debt, the First 5,000 Years, and he talks about how debt has been used over the course of human history in many ways. And I think that I mean, yeah, there's so much to say here. Sorry, I'm trying to collect my thoughts, but I think that with the international organizations set up the way that we have, obviously very colonial in their legacy, and there was even an example where Haiti successfully fought off the I think it was French colonists, and yet then France imposed a tax and they even though they had won their autonomy to be able to exist on the land, then they were still put into debt, and that has continued to plague Haiti and to this day, and I think that the whole international system of debt is highly problematic and only getting worse. And I agree that I'm not really sure how it ends, but I would say that in David Graeber's book, he says that throughout history, there have been these massive accumulations of a debt burden, and then there have been popular uprisings to essentially have a debt jubilee where you break the papyrus tablets, or you eradicate the debt ledgers, whatever form they took. And it actually happens remarkably often throughout human history and in a fairly regular cadence. And I think that we're at that place now where the debt has become so unsustainable that I would not be surprised in the least if you had countries banding together and simply opting out of their collective debt obligations to the major international institutions and saying, like, we're just not going to pay this anymore because it's so untenable at this stage. So yeah, so I agree with that. I think that's a really interesting area of study. It's only, as I mentioned, it's not my area of expertise, but I think to the second, Hani, thank you so much, or Hani. The shareholder value idea, I agree, is also broken. It's also interestingly broken because, as I mentioned earlier now, so much of shareholder value is generated from, well, it's interesting now, I think it's 85% of S&P value is now intangible value. So things like intellectual property, patent rights, goodwill, and of course there is benefit in having, your intellectual property. There's huge value there, but I do think it's interesting that shareholder value has kind of divorced from a lot of, really, I guess the real economy in many ways, and from even growth itself. Like, companies are not growing, and yet their market capitalization is growing. And so, if you think that shareholder value is the best way of allocating resources, I think that the current structure of the economy, and particularly of corporate valuation, really does give us reason to pause, and actually, I think, fundamentally breaks the relationship between shareholder value and corporate profits and all of that. And so even if you're not thinking about this in any other terms, I think that the current structure of markets gives us reason to want to rethink this kind of corporate governance. And I think that there are some interesting proposals around new forms of ownership and governance, stakeholder ownership and governance. But I think that they would need to be much more, like, one interesting thing I think is let's say, if a company is taken on by the DOJ in the US for antitrust, or in the European Union, one of the remedies that they could propose would be more stakeholder ownership, whether it's worker ownership or maybe they turn them into a co-op, or I don't know. But I think there would be really interesting ways of saying, okay, instead of just a breakup, or instead of just imposing fines on, monopolists, what if we use the tools of alternative forms of ownership and governance with corporations as remedies in antitrust cases? So I would like to see more of that experimented with.
Hey guys. Any more questions? So Denise, I would love again to conclude, and I would love to borrow one of your quotes that you did not say today, but you said it in one of your other presentations with other speakers that I watch over the YouTube before today's, that you were talking about capitalism, and it is not that you think that capitalism involves too many companies. Actually, the opposite. You have very few companies out there under the current system, and you clearly today showed us all of these mergers. Capitalism allows what is called big companies to have economic gains and encourages the idea of too big to fail. So as Dr. Ali just mentioned, once you're about to fail, the government will step in, bail you out in order to save the economy, because again, you're hiring maybe like GM, General Motors, and other companies, AIG, Bank of America, Lehman Brothers already failed. So I would bring also Warren Buffett quote when he says that he pays lower tax rates than his own secretary. So again, the system, as you mentioned from the book, The Myth of Capitalism, it doesn't show us that capitalism is actually a fair system to be applied. Or maybe it has some defaults, some issues here and there that needs to be fixed. And I believe the word would be here regulation, if you agree with me. We need strong regulations on big companies in order to avoid or to help the society stay away from their greed. So if you want to say something to the audience, Denise, and we'll go after that.
Just thank you so much for having me. I really enjoyed the conversation. And if anyone would like to be in touch with me, the easiest way is on my website, which is just denisehearn.com, and you can contact me there. I also have a newsletter that I just launched called Embodied Economics, and there's a link to it on my website as well if you'd like to sign up to that. I do writing about all these things that I'm thinking about. And other than that, yeah, just thank you so much again. I really enjoyed this, and I hope everyone found it useful, and would love to engage on any ideas or thoughts that you have moving forward.
Okay, thank you, Denise. On the behalf of the American University in Cairo, on Gerher Center for Philanthropy, Civic Engagement, and Responsible Business, for Dr. Ali Aouni and myself, we were very delighted to have you today, and hopefully to see you soon often. Thank you very much, Denise. Thank you for everybody around. Happy, and hopefully we'll come around for another session soon. Thank you. Thank you, Denise. Have a wonderful day.
You too.